Anna is going to cover off what to consider when you're looking at your investing strategy. So over to you, Anna.
Right. So we often hear that it's important to have an investing strategy when you first start out investing. So what exactly does that mean to have an investing strategy? Well, it's basically an approach to investing that guides an investor's behavior based on rules and guides. And some of the things that you kind of need to take into consideration are the ones listed here. So risk tolerance, asset allocation, diversification, your timeline, and then also your personal circumstance. So I'll dive a little bit deeper into each of these in the next couple slides. So when it comes to risk tolerance, this can be in the form of how much of your investment is defensive, so more stable assets that you might hold. And this is like bonds, fixed interest, cash. And then the other side of it is how much of your portfolio is in growth assets. Again, this might be a little bit less stable, but often it's an expected higher return. So there's a lot of controversy around some of this, especially when it comes down to what the balance should be. In the past, it's been talked about that potentially you want to hold bonds around the same percentage of your age. Some of the theories around that have changed as well, but it is really important to think about your risk factor and your tolerance depending on your age, when you might retire, and what needs to be taken into consideration. So in terms of asset allocation, which is the next one, this includes looking at what asset classes you actually hold and what percentage of your portfolio is allocated to them. So asset classes include, again, cash, shares, bonds, property, precious metals, crypto, and thinking about what percentage you hold of each of these is really important. The thing is, we never know what asset class is going to perform well year over year. So ensuring that your portfolio is as diversified as possible can mitigate some of that risk and volatility. If you look at this graph that we have here, it shows actually which of the best performing asset classes are held by year. So as we've heard, it's hard to predict what the future holds. And if you look at this, you can see that in 2020, it was international fixed interests that are hedged and international equities that were the best performing. In 2019, it was Australian listed property. In 2018, it's small cap. So we can't really guess what the future holds. And that's why having a diversified asset allocation can mitigate some of that risk when it comes to volatility. We can only guess what happens in 2022. In terms of diversification, this includes various areas that you need to consider, such as sector, industries, markets, also countries. How much of your portfolio is Australian versus global versus US equity, and also just that kind of those nuanced spaces in terms of tech and finance. How much is weighted within all of those different areas. It's also worth considering the currencies within your own diverse portfolio, which Jessica mentioned as well, and how that might play into your portfolio. So again, this comes down to trying to mitigate any risk by being as diversified as possible alongside this. When it comes to timeline, this is a very interesting one as well. If you're a newer investor, you might have a longer time horizon to invest. So you can actually kind of weather the storm of the volatility, of the ups and downs of the market, especially if you're a new investor right now and the market is a bit of a bear market. It's you're seeing a lot of red and negativity, you can see it in the minus. But the thing is, if you have a long time horizon, that should be less of a risk for you. However, if you're closer to retirement and you have a shorter timeline, you might want to actually allocate some more of those defensive assets in order to kind of balance out that volatility. And if you have goals that you're planning for, whether it's financial independence or retirement or buying property, considering all of that within your timeline is really important. We have goal setting on Perler as well that you can kind of set up and actually track those timelines and help guide you in terms of your own investment strategy. And then the last one is personal circumstance. It's really important to kind of reassess what your investment strategy is based on some of that personal circumstance. So similarly, this can be, you might have had a change in your life in terms of your income. It might have increased, or a loss of income. Buying property is a huge one as well, having a child or combining your finances, and then inheritance. And of course, winning the lottery, because who doesn't want that to play into their own financial strategy when it comes to their portfolio. But nonetheless, all of these are really kind of important because they can change the way that you might view your portfolio and your strategy within that. However, often it's kind of thought that if these big changes do happen, your strategy is kind of there to hold on for a longer period of time. So it's sometimes suggested to not make quick judgments or changes to your portfolio, but maybe wait it out for 3 to 6 months when these big changes happen.